If we look at what's happened since the beginning of this year, over 400 tons of gold has been stood for delivery. Now, imagine that you're a bank, a bullion bank, whatever. Then probably what you're doing is you're saying, we could have a problem here. We need to get cover for those liabilities. And I think that is why we saw the premiums on futures jump to really very, very high levels, creating the arbitrage to suck in the liquidity from elsewhere.
Recent developments in London's precious metals vaults have caught the attention of global financial markets, signaling significant shifts in the trading landscape. As of March 2025, the London Bullion Market Association, LBMA, reported 8,488 metric tons of gold stored across commercial vaults and the Bank of England, reflecting a slight 0.1% increase month over month. Meanwhile, silver reserves have dropped by 1.5%, now at 22,127 tons. These outflows in silver, combined with rising geopolitical tensions and evolving trade policies, point to broader shifts in the demand for precious metals. Notably, the potential for U.S. tariffs on metals has triggered an unprecedented flow of gold from London to New York, further complicating the global market environment and highlighting how changes in one market can ripple through others. A key driver of this movement has been the sharp rise in COMEX futures premiums, which created a large-scale arbitrage opportunity that drained liquidity from gold markets across London, Switzerland, and even bonded warehouses in Mumbai. This wasn't just routine inventory turnover, but a direct response to escalating demand for physical gold settlements, with a particular focus on increasing stands for delivery on COMEX. Since early 2024, more than 400 metric tons of gold have been stood for delivery, a total approaching that of the previous 4 years combined. This shift reflects a growing preference for physical gold over paper claims, driven by concerns over counterparty risks in an increasingly volatile market. The tightening of liquidity across the London Bullion Market Association and COMEX has led to a brief but significant drawdown of global inventories, intensifying the pressure on the global gold market. With these ongoing shifts in demand and market behavior, Alasdair Macleod notes that the shortage of leased gold exacerbates the strain on global liquidity. The Bank of England's backlog of gold withdrawal requests highlights a growing challenge as central banks question the viability of leasing gold while stockpiling it as a hedge against paper currency instability. This drying up of leased gold, once a key source of liquidity in the derivatives market, is now creating significant pressure across the entire gold market, tightening supply and increasing volatility. We present the clips of Alasdair's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
They are meaningful. I mean, the people within the system are trying to dismiss it by saying, well, actually all it is inventory is moving from one place to another, but it's not really changing. I don't buy that line at all. Basically, the first thing that happened was there were significant premiums on the futures market on COMEX. And this set in train an arbitrage, which basically cleaned the liquidity out of London, Switzerland, and even Mumbai. Gold held in bonded warehouses, not yet entered and therefore not yet taxed, went to London. I mean, it's the most extraordinary thing. You have to ask yourself why. There was the threat of 25% tariffs on gold, silver, everything. I didn't really buy into that story. I could understand why it would trigger concerns that there would be a possibility. Yeah, I can understand that. But there was something else there. And I think it's to do with the stands for delivery on COMEX. Because I've been monitoring these for, the last 4 years or so. And particularly since Trump was elected, the pace of these stands for delivery in both gold and silver accelerated very, very substantially. To give you a clue, in the last year, 2024, the stands for delivery were a little over 2,000. I think it's 400 odd tons, something like that. The 2,100 ton figure I've got in mind is actually for the last 4 years, up until 2024. What has happened since then is the pace of these stands for delivery has accelerated. Now, with stands for delivery, we don't know. But, the experience suggests that if you actually want to take position of your stand for delivery, it's not easy to do. And it's something that probably takes a certain amount of time and all the rest of it. So what we have seen in the past, particularly after COVID, we saw there was that peak, if you like, in stocks, in the warehouse stocks for gold and silver. And then the level of stocks declined and declined and declined into the beginning of the fourth quarter, 2024. Now that would reflect, amongst other things, people who stood for delivery withdrawing their bullion from COMEX warehouses. But there was probably still some which had not been delivered and therefore still there. Okay. Now, if we look at what's happened since the beginning of this year, over 400 tons of gold has been stood for delivery. Now, imagine that you're a bank, a bullion bank, whatever. Then probably what you're doing is you're saying, we could have a problem here. We need to get cover for those liabilities. And I think that is why we saw the premiums on futures jump to really very, very high levels, creating the arbitrage to suck in the liquidity from elsewhere. But then there is something else that has been triggered in this. It was really quite surprising in a sense that gold was leaving the Bank of England in large quantities, so much so that there was a significant backlog, I think, towards the sort of mid-April. We're getting to there now, sort of, if you like, bullion banks or bullion owners trying to withdraw their gold. Now, let's be clear about this. This gold is not necessarily owned by commercial entities in the sense that they have probably leased it, so they have temporary ownership of it. So, the Bank of England has no power, as I see it, to stop them withdrawing their gold. The problem is that this is leased gold. Central banks are looking at this and they're saying, hold on a minute, we're buying gold in the markets because we're worried about the prospects for paper currencies. Why should we be leasing gold at the same time when it goes out of the Bank of England and we're not necessarily going to get it back at the end of the lease? Doesn't make much sense. So I think the other thing that we're seeing in this is we're seeing the supply, which has been the liquidity pushed into the markets, bullion liquidity pushed into the market, if you like, providing the basis for the whole of the derivatives industry, both in London and also in New York. That supply of leased gold, providing that liquidity, is not there anymore. That's gone. That's going. And that, I think, is going to have a major impact on the future value of gold and the way in which these markets operate. And, it's one thing when you see a derivative market, if you like, a derivative product expanding and there's demand for it. The system adjusts quite rapidly to produce the credit for that. But it's another thing when it starts contracting. And it's then that you potentially have systemic risks rising. And they could be rising very, very significantly. And because gold is fundamental to the whole thing, it could be that those risks actually also produce higher risks in other derivative markets, foreign exchange forward settlements and, other commodities and all the rest of it. Interest rate swaps, I wouldn't put into that category because an interest rate swap doesn't involve the principal. It only involves, the principle is there, if you like, but you don't, it's not settled in principal terms in any way. It's just an interest rate swap. As for all the other derivative markets, a contraction of the gold derivative market system could have very nasty knock-on effects for the whole thing. And we're talking about hundreds of trillions of dollars of credit. So, I think it's a space to watch.
The IMF's recent warning about the significant risk posed by Donald Trump's tariffs on the global economy underscores the delicate state of international trade and economic stability. IMF chief Kristalina Georgieva stressed the importance of avoiding further escalation of trade tensions as markets worldwide took a heavy hit following China's retaliation against the U.S. tariffs. This creates a concerning backdrop for the global economy, which is already grappling with sluggish growth. The IMF's concerns are compounded by the uncertainty of the Federal Reserve's response, with many expecting interest rate cuts in an attempt to stabilize the economy. However, such measures are not a cure-all, as foreign investors who hold vast sums in U.S. equities are unlikely to remain in the market if it continues to struggle. Instead, they are expected to liquidate their positions and move to safer assets, such as their national currencies, further weakening the U.S. dollar. According to Alasdair Macleod, the dollar's recent decline, reflected in its trade-weighted index, signals an impending financial crisis that may force the Fed to raise interest rates to attract investment, which only deepens the debt trap the U.S. finds itself in. This could exacerbate the downward spiral, as higher interest rates will burden an already strained financial system. Given these challenges, the focus is shifting to hard assets, particularly commodities and precious metals, as safe havens for investors seeking stability. Despite the recent volatility in gold and silver prices, these assets are seen as long-term stores of value. Alasdair Macleod points out that as the dollar's value continues to decline and inflationary pressures persist, precious metals will likely serve as a secure store of value.
The market's initial reaction rather confirms this. These tariffs are basically driving the global economy into recession, slump, depression. I don't know what we'll call it. The consequences of that, of course, are that tax revenues will disappoint, welfare costs will be higher than anticipated. Government finances will take this very, very badly at a time when government finances are actually in a debt trap. So you then have to ask yourself the question, well, how does this affect interest rates? Because everybody's assuming that interest rates will go down. The Fed will lower interest rates because they have to, and they're going to have to rescue the economy, etc. It's the Keynesian playbook, but it's complete rubbish. In fact, the correct way to look at this is the way the foreigner will look at, say, his investment in US equities. They've got something like 14, 15 trillion, depending on valuations, invested in US equities. That is a hell of a lot of investment. They're not going to hang around while a bear market rages and just sort of sit on their position. No, they're going to sell it down. They're going to panic out. They're bound to. And are they going to go and buy US treasuries and corporate debt? The risk-free alternative? No, as far as they're concerned, that's not the risk-free alternative. The risk-free alternative is to get into cash in their own currency because they're running balance sheets in their own currency. If they're going to see no risk at all or minimal risk, it's got to be back into their own currency. It doesn't matter how bad the currency is. That is where the buying is going to go. And we've seen this reflected already in the dollars trade weighted, which, you look at the chart of that, it's awful. That's the only description I can give it. It fell 2% yesterday. It's like more than 2%. It's steadier today, but there's no doubt, looking at the chart, that's going to go below 100. It's currently 102. Going to go below 100, and it's going to be on its way to 90. And we see what happens then. Allegedly, Trump wants to see the dollar lower. He's going to get his wish. This is very, very bad news because how does the foreigner then get enticed back into the dollar? The answer is you've got to offer him an interest rate to entice him back into the dollar. You then look at the consequence of interest rates on the debt trap. And oh dear, this gets worse and worse and worse. In other words, we're getting into this sort of maelstrom, if you like, whereby everything's going round and round and round and disappearing into the black hole of nothingness. That is basically what's happening. And it's happening to the value of credit. You cannot reduce the amount of credit outstanding without banks or businesses going bust. That is the way outstanding credit gets reduced. If it's not going to get reduced that way, then it gets reduced in its value. So what will happen is that the Fed will be pushed into interest rate policies which basically destroy the dollar. And we're just in the early stages of this. And as for the commodities, this reaction actually is completely wrong. But it's understandable, being the first, if you like, the initial shock. And bear in mind also that there's still quite a bit of leverage in the US equities. If you look at the FINRA numbers, I think in February it was a short $1 trillion of debt, leverage in the market. That's getting caned, absolutely caned. So you can see that this is not good. It really is not. And first reaction to hit everything, including commodities. I think that swaps, if you like, in gold and silver and in other commodities, the other futures commodities, understandably trying to close down their positions. So they bash these prices, they bash them down. And of course, nobody wants to challenge them at the moment. They will manage to close some of their positions at a lower price. I don't think they will in gold. There might be some, but I mean, gold is interesting because on COMEX, there's less than 500,000 contracts outstanding, which is not an overbought situation, if you like. You don't have all these hedge funds long of gold, short of dollar. No, they're not at all. So the amount of stuff that's going to get shaken out on the bull tack, I think, is going to be disappointing as far as the swaps are concerned. Different position, obviously, in silver, because you haven't got central banks buying silver, which effectively is the backstop on gold. And on that basis, this is why silver has fallen by, 6%, 6.95%, I see on my chart today, having had another very big fall yesterday. So that, I think, roughly is where we are, Jesse. It's interesting times. I see this in two phases. I see the initial shock, and then I see people looking at things a little more rationally, and then looking at the opportunities. And to my mind, the opportunities are quite simple. Because it's the dollar going down, buy commodities, buy precious metals.
The recent dip in gold prices presents a buying opportunity, with Goldman Sachs analysts maintaining a bullish stance on the precious metal. They attribute the decline to short-term technical factors, such as position liquidations amid the equity market sell-off and shifts into alternative assets. However, Goldman views gold as a strong defensive asset, especially with global growth concerns tied to the U.S. government's reciprocal tariffs. The bank maintains its year-end gold forecast at $3,300 per ounce, ranging between $3,250 and $3,520, seeing upside risks and reinforcing their conviction in gold's long-term value. With inflationary pressures, ongoing geopolitical tensions, and uncertainty in financial markets, gold remains an attractive hedge for investors seeking stability. Analysts also note that as interest rates fluctuate and global trade tensions persist, the demand for gold could increase, reinforcing its role as a safe haven asset in uncertain times. That's it for today. Share your thoughts on Alasdair's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.